Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Bhavin Shah, who is the founder and fund manager at Sameeksha Capital. Bhavin, thank you very much for joining us on BQ Prime. Let me begin with when we spoke to you last time, you had highlighted that there are global headwinds which are coming in form of inflationary pressures, and central governments would be taking action. As we stand today, we have seen a lot of action taken by lots of central governments. Where do you see this cycle of interest rate now, ebbing and returning to normalcy?
So, Sajid, if you see the recent data on inflation, uh, I think we are starting to see, at least on a sequential basis, uh, a significant fall in inflation. Now, in case of India, core inflation is still high, but overall inflation has started to come down. And in case of US, month-on-month data definitely suggests that inflation is cooling off quite a bit. And I think it's all because of the tighter monetary policies that have been adopted, as the interest rate tightening included. So I have to think that we probably have seen the worst of the inflation, and while there could still be one or two, maybe one more interest rate hike, if a particular central bank wants to play safe, the cycle of rate increases probably is towards its end.
Especially in the US, one of the market is penciling in that that rate hikes could go on further till the Fed achieves the target level of 2.5% of inflation, which they are comfortable with, uh, as compared to India, where they are already coming into the band of 4 to 6%. Do you see how do you see this playing out in for global equity and flows?
I think the global equities and India. I think when I look at the target inflation being 2%, I think if you look at the sequential data, it is definitely suggesting that we are kind of close to that number. So so I think that's the backdrop. If you look at the equity valuations, let's say we look at US and India. I think we are the in case of US, the Schiller P, which kind of looks at a longer term earnings, normalized earnings, and on that basis, it's sort of close to an average level now. So I think only thing that I think that suggests the valuations are a bit stretched in case of US is the market cap to GDP ratio, which is still high compared to the historical levels. I think the other thing is that while we have seen a lot of cutbacks in employment in technology sector, there hasn't been as much in the rest of the sector in the US economy. So it is possible that we may actually have a slowdown, but not a deep recession. And I think market may start to think about that. And I think we might actually see a better stock market in 2023 in US than what we saw in 2022. I think probably we might see a small increase this year is what I feel. As far as India goes, obviously our markets have actually been sort of weak for at least around 12 months. There has been primarily a appreciation in certain sectors. And I think even today, what I feel is that it is going to be a bit more of a sector specific and stock specific situation in India. We actually quite like the macroeconomic backdrop for India for a number of factors. Whether it's the fiscal position of the government, the tax collections are very strong, which I think gives them breathing space to do what they need to do to keep the economy going. The inflation, I think, while the core inflation is still a bit on a uncomfortable level, chances are that it might start to come off a bit. I think there are, the commodity inflation, the crude, all that is favorable. And I think underlying economy, in terms of demand perspective, looks pretty healthy. So with that in mind, we might not see a big rally because of where the valuations are. But I think one would find number of opportunities in this market across many sectors is what I feel.
Mhm. If someone would have asked a year back that outflow of $30 billion from foreign investors and the index would be at the same level, no one would have agreed to. It's primarily because of domestic flows which have come in, and that's holding on the index at these levels. How do you see the domestic valuation picture looking, uh, especially from the point of view of, as you said, macros are improving, but at the same time there is some pressure on earnings which is there. So how do you see, if you put both of them together, how the valuation is looking for the domestic market?
I think, see, March 23 year, we probably saw a lot of normalization in and margins. Some sectors, especially where there were a lot of one-off type of effects, whether it's COVID benefit or whether it's price increases in some commodities. Those benefits obviously sort of kind of reversed in 2000 FY23. I think so. March 24, if you think about it, might look a bit more of a normal year. And I think if the interest rate cycle is sort of near its peak, we probably, with a strong demand, I think we might see decent earnings growth as well. So overall, I think the market outlook is more positive, definitely in my view, than again, the calendar year 22 that what we saw. But I think the one I would have to kind of find opportunities and evaluate on a case by case basis, because what is happening is the breadth in the market is increasing. We are seeing so many new listings, so many IPOs. I think and so the money will, while as you said, the domestic money has really supported this market. There's a lot of money that is also going into new kind of sectors and new companies. Last year a lot of money went into public sector, for example. So that, I think, process kind of might still continue, and so we may not see a big rally in the overall index, but I think there will be a lot of opportunities in specific companies or sectors.
You mentioned about the public sector money going to public sector companies. Nifty Bank was a good example of that, where where the PSU banks narrowed its valuations with respect to private sector. Do you see there's enough steam left in PSU banks to go through for 23-24?
So I think when we look at what is driving this kind of resurgence in PSU Bank, and I think a lot of people have kind of a lot of people got in early and got disappointed with the finally the PSU sector, PSP Bank, public sector banks have re-rated. And what is I think the fundamental reason is obviously their balance sheets have improved significantly, but I think also on an ongoing basis, it seems that the Reserve Bank is having a much tighter watch on the numbers of all the banks, not just public sector banks. So the risk of another big sort of NPA crisis developing seems rather low at this point. And so it is possible that, and I think there seems to be a lower level of interference in the governing of the public sector banks. So it is quite possible that while we may not see the kind of rally that we saw last year, I think some more appreciation in the public sector bank might continue, because they still are attractively valued relative to the private sector banks. And so that process may actually continue this year.
One of the sectors which you used to track very closely was IT.
Yes.
You've seen a large companies coming out with earnings last week, TCS, Infosys, HCL Tech, and Wipro. How do you read into those earnings? And do you see some pain points emerging, or initial pain points emerging in those earnings?
Look, the fear is there that, and I think the clear kind of linkage is that if US corporate profits suffer, the IT spending, takes a, impact, and that obviously translates to lower growth for Indian IT companies. So that relationship, I don't think is going to go away. Though some of the initiatives, some of the urgency to invest in modern technologies may actually continue, and as a result, we may not see as big a dip as one might see. But the question is whether there is going to be a meaningful erosion of corporate profits. And I think so far the signs are not there. And I think look at the commentary of the companies also. they're still seeing a pretty decent demand picture. We have already in middle sort of middle of January, so there has been a lot of budget discussions have already happened. And I think I can actually feel that we might get slightly positively surprised with respect to growth, demand growth in the sector in the coming 12 months. And that I think while the valuations are kind of mixed. There are some IT companies which are attractively valued. I think the market is still not believing in their story, in the sense that they actually are talking about a lot of structural improvements in the market. I think wants to see more of it, and so they are still available at good prices. Whereas the well-known names are not that attractive. However, when we compare the stocks in the IT sector with the rest of the sectors in the Indian market, especially the companies with similar quality of earnings, similar return on capital, similar dividend payouts, and similar growth opportunity. IT sectors actually looks very attractively valued. We have been very cautious on the sector for some time, but I think going forward we might want to be a little bit more positively biased, is what I would say.
How do you see the large caps within the IT sector versus the mid cap companies? Do you see mid caps being able to able to handle the kind of volatility that may come in this sector?
I think, see, the what has happened is that the IT outsourcing, the offshore model is so well established, and the quality and maturity of execution, the capabilities in the mid-sized companies also very well evolved.
Hmm.
So we may not see like mid-cap companies suffering more than the large cap, and that kind of behavior may not be visible. And I think market sort of is reasonably efficient about it, and I think we are seeing pretty decent valuations also. Of a good quality mid-cap companies are not that cheap actually. So I would say that the opportunity will primarily across large or mid-cap would be in companies which may have had somewhat checkered history in the past, but for a number of factors, they are actually likely to do better in future. Those would be sort of interesting turnaround opportunities for sure. Whereas the well-established names, large cap, mid cap, I think they probably will still do okay, but not as well as some of this kind of quote unquote turnaround opportunities.
If in your portfolio, which is the sector that you're overweight as of today?
I mean, I think we are very, I would say, diversified in our portfolio. So it is difficult for me to tell you where I'm overweight. We have exposure to a whole range of things. I don't think we are overweight per se. I don't think there is a reason to be overweight in any sector. There are a number of opportunities across many sectors. If there is one in terms of number of names in the sector, we're quite interested in the space related to wealth management. You mentioned earlier in the our discussion how the domestic investors supported the market even with such a big outflow from foreign investors. So there are a number of companies in the wealth management space, actually relatively smaller companies, that are doing some really interesting work. And those companies are not yet fully appreciated by the market in terms of the way they are priced. So we are seeing opportunities in that space. So I could argue that we are slightly overweight there.
Okay. You benchmark against the BSE 500 TR, and that had a return of 4.7% for last 1 year. Compared to your fund, I think there is a marginal dip there of 2% odd, if I'm not wrong. Where is it underperformance coming in from? Which sector?
I think we had underperformance from financials. We had, I think, very little participation in the public sector. So I think there was a clear underperformance from the public sector space. We obviously had no exposure to any of the names in the Adani group, so obviously underperformance there as well.
Tell me, you were a little skeptical about the commodity and metals last year when we spoke to you. What is your view today on metals and commodities?
I think the sector outlook is probably better now. I think China, with the complete kind of opening up, removing all restrictions of COVID, I think we might see improvement in demand from that and that segment. I think obviously globally there is probably some risk of a slowdown, but I think all that is sort of probably priced in. So the outlook would be a little bit, definitely better than what it was last year. Though we don't have any big exposure there, it's a difficult space for us to really kind of get hold of. So
Hmm.
unless we see a real bargain, which is like asset available below its replacement value, we tend not to invest there.
Hmm. You know, have you changed your view on the new age companies? Because you were a little bullish on those companies last year, and they were holding gains. But today, in the last 1 year, there has been a lot of losses for those companies. What's your view on there, and have you changed your view on them?
Well, we have, first of all, we have, what we have said is that while some of the new age companies have business model that will last, and especially with nice watches, some of them have, they would definitely ride through the kind of the phase of, basically losses. But we have never really kind of invested in that space because we never really have found attractive opportunities in that space. I mean, even today, I think the kind of view is somewhat similar. While there has been fair bit of correction, I don't think we are finding enough number of names where we have reached a right point of valuation with respect to versus the growth opportunity. But we'll continue to. I think, given the correction that has happened, we might maybe in the future we might find something that is worth owning.
Bhavin, you've looked at the technology and tech space very closely. How do you look at these kind of companies for an investor? What kind of parameters do you look? And when you say that they're going to be still loss making, but at some time they have to start making cash flows positive. How do you value them? At what price do you think that it's an inflection point for them, for anyone to identify?
So I think what we are willing to do is we are willing to look as far as required to understand such companies. So maybe the opportunity is over a spread of next 25 years. We don't mind thinking about 25 years for such businesses. If the idea is that you have to separate, say, a mature part of their business versus the new, let's say they are well established in one geography, and the financials there are looking like they are making money. Their returns are starting to generate the good returns, for example, in on capital. We are willing to separate that versus say new areas where they're still investing, and basically draw from what they have achieved, or what to kind of extrapolate for the new areas or new geographies or new kind of verticals where they might be investing. But after doing all that, it still has to make sense from a cash flow standpoint.
Mhm.
The cash flows may come 5 years later. That's okay. But if after making those assumptions, if you're not justifying it on on the cost of capital that this business is, after discounting those future cash flows, then we wouldn't invest.
How,
So
how how do you look at some of the companies? I'm just going throwing a name here for purpose of discussion, like a Mama out there, right? They are into FMCG, but into online space. Uh, when you look at an FMG space, you need to look at a traditional one, but because they're an online, you need to look at little differently. So, how do you value such companies?
no, we still will value it like an FMCG company. As I said, we would look at their current phase of investment, try to kind of go deep into how long will that phase continue? What will be the ultimate, the scale? We look at the size of the opportunity. How big is the potential of opportunity that they have? Obviously, they might have a potential to expand into adjacent spaces and so on and so forth. So we would try to do all that. And but after that, again, it will still boil down to whether on a cash flow basis it makes sense. even if, as I said, the cash flows can come 5 years later, 7 years later, that's okay. I think it is similar to looking at even things like, say, life insurance, right? Because it's a lot of Indian life insurance companies are in a heavy growth phase. But ultimately there has to be earnings, there has to be payout. That sort of model has to work eventually.
Even the public sector life insurance company means, do you do you have exposure to that, and do you compare that with the private sector before you invest?
So we have exposure to one of the public sector life insurance companies, which is sort of very well. Their numbers are fantastic. The growth story is excellent, and they're very comparable to private sector life insurance companies. So we do have exposure to one public sector life insurance as well as one private sector life insurance, because we see that sector as a growth sector. The huge runway for growth, and so if the company is well run, then I think they manage the risk very well, and the matrices such as the persistency ratios are good. Their ability to estimate their embedded value is good, in the sense that they are not having to revise it down as time goes. All those factors we look at, and then and then if it makes sense from valuation standpoint, we would invest in.
Hmm. Just to coming to an end of the thing, we saw the index giving a gain of 4 to 5% last year in 2022. Uh, do you see double-digit returns coming in 23 for the index? What could be the challenges for that 20 double-digit returns, if at all?
I think the challenge is that the global economy goes through a much deeper recession than what we think it will. So that would obviously affect some segments of the Indian economy. Our export part of the story will get affected. So that is one risk that I can see. I think other than some kind of event risk, black swan event, etc., etc. But no, absent that, I think the outlook for to generate higher returns in 2023 definitely is there. I wouldn't want to guess the number because I haven't honestly done that work. But yes, I think looking at all the parameters, it looks like we could have a stronger year in calendar 23 for India.
And from a macro point of view, you have some of the challenges which are there, which is coming in. Plus, a lot of states are going for elections, and then we are heading towards a general election in early first half of 2024. Uh, what kind of headroom do you think the government has with respect to spending? Because last year, the biggest highlight for the budget was the capex, which the government announced. We didn't see that capex fully taking off in the first half, at least first 9 months. We're hoping that now in the last 3 4 months it will pick up. But do you see continued thrust on capex, and do you see further headroom for the government to have to be there for them to continuously invest in capex and other investments?
I think the space is definitely there for government to continue to push the pedal on capex. There is definitely if you look at all the tax numbers, the financial situation, is looking pretty good. So I would say that they will continue that. I think when we see the budget, I expect them to continue to support capex because I think they have very lot of ambitious plans, and to complete a lot of projects, and I don't see them slowing down. I mean, I think also this is also a statewide story, and I think what we are seeing is a healthy bit of competition, across states. The states that have where governments have done good job with building infrastructure, capacity, and I think they've also got re-elected. So recently, for example, one of the states, I think Telangana, where there is an election coming as well. I think they talk about infrastructure basically push as a kind of ahead of the election. So there is that the thought process, the language is definitely supportive of central and state government continuing the capex push.
Mm-hmm. Bhavin, it's been a pleasure today talking to you. Thank you very much for joining us on BQ Prime.
Thank you, Sajid.
Thank you. Bye.